A bear market rally is a sharp, short-term rebound in share prices amid a longer-term bear market decline. A bear market is a sustained, market-wide downturn of 20% or more. A bear market rally may also be called a sucker's rally, bull trap, or dead cat bounce. It can trick investors into buying stocks just before they plunge again. Some analysts think the S&P 500, Nasdaq and Dow experienced a bear market rally in July because they recovered some of their losses from the previous months, but did not break out of their downward trend. They argued that the relief gains were not in line with deteriorating investing fundamentals such as rising interest rates, inflation, and slowing economic growth. They also pointed out that the rally was driven by a few large-cap stocks, while most of the market remained weak. A bear market rally can be hard to identify until it unwinds. Investors focused on the market's fundamentals and familiar with the history of bear market rallies stand the best chance of avoiding these traps. Bear market rallies are often followed by new lows, as the primary bearish trend reasserts itself. The disappointment of those who bought during a bear market rally helps to drive prices to new lows. While the stock market has been soaring to new heights, there are also some risks and challenges that could derail the market rally. In this section, we will discuss some of the factors that could pose a threat to the bullish momentum and how investors can prepare for them. One of the biggest risks is a change in tone from the Federal Reserve. The Fed has been very supportive of the market recovery by keeping interest rates near zero and buying trillions of dollars worth of bonds. However, if the Fed signals that it will start tapering its bond purchases or raising interest rates sooner than expected, it could spook the market and trigger a sell-off. The Fed has said that it will be patient and data-dependent, but investors should pay close attention to any hints of policy changes. Another risk is higher taxes. The Biden administration has proposed to raise taxes on corporations and wealthy individuals to fund its ambitious spending plans on infrastructure, social programs, and climate change. While these plans could boost economic growth and create jobs, they could also hurt corporate profits and investor sentiment. The market has been largely ignoring the potential tax hikes, but they could become a reality if Congress passes the legislation. A third risk is more regulations. The Biden administration has also vowed to increase regulations on various sectors, such as technology, healthcare, energy, and finance. These regulations could limit the growth potential and competitive advantage of some companies, especially the big tech giants that have been driving the market rally. For example, the antitrust lawsuits against Google and Facebook could result in fines, penalties, or even breakups. A fourth risk is increased M&A scrutiny. The Biden administration has also appointed some aggressive antitrust enforcers who could block or challenge some of the mega mergers and acquisitions that have been fueling the market rally. For example, the FTC recently sued to stop NVIDIA's $40 billion acquisition of ARM, a chip designer. These deals could face more hurdles and delays under the new administration. A fifth risk is slow growth in Europe and Japan. The U.S. economy has been outperforming its peers in Europe and Japan, thanks to its faster vaccination rollout and fiscal stimulus. However, if these regions continue to lag behind in their recovery, it could drag down the global growth outlook and hurt U.S. exports and earnings. Moreover, if these regions face new waves of COVID-19 infections or variants, it could pose a risk to the U.S. as well. A sixth risk is high valuations. The stock market has been trading at record high levels, with some indicators suggesting that it is overvalued or overbought. For example, the S&P 500's forward price-to-earnings ratio is currently at 21.6, well above its historical average of 16. The market's valuation reflects high expectations for future earnings growth, but it also leaves little room for disappointment or error. A seventh risk is COVID-19 variants. The U.S. has made remarkable progress in containing the pandemic, with more than half of its population fully vaccinated and daily cases and deaths falling sharply. However, there is still a risk that new variants of the virus could emerge or spread, especially among the unvaccinated population or in other countries. These variants could be more contagious, more deadly, or more resistant to vaccines, which could lead to new outbreaks or lockdowns. An eighth risk is the debt ceiling. The U.S. government has reached its legal borrowing limit and needs Congress to raise it or suspend it by mid-October to avoid defaulting on its obligations. While this issue has been resolved many times before without much drama, there is always a possibility that political gridlock or brinkmanship could create uncertainty or volatility in the market. A ninth risk is a shift in sentiment and algorithmic trading. The stock market is driven not only by fundamentals but also by emotions and psychology. Sometimes, investors can become too optimistic or too pessimistic, creating bubbles or crashes that are not justified by reality. Moreover, with the rise of algorithmic trading and passive investing, market movements can be amplified or distorted by computer programs that react to signals or triggers without human intervention. These are some of the risks and challenges that could derail the market rally. Of course, these are not predictions or guarantees, but rather scenarios that investors should be aware of and prepared for. The stock market is unpredictable and volatile by nature, so it is important to have a diversified portfolio that can withstand different market conditions and a long-term perspective that can ignore short-term noise. The stock market has been on a tear lately, with the S&P 500, Nasdaq and Dow Jones all hitting new highs in May. But what can we expect for the market in August and beyond? In this section, I will give you my outlook based on technical analysis, valuation metrics, and sentiment indicators. First, let's look at the technical analysis. Technical analysis is the study of price patterns and trends to identify potential support and resistance levels, as well as bullish and bearish signals. One of the most important technical indicators is the moving average, which is the average price of a security over a certain period of time. Moving averages can act as dynamic support and resistance levels, as well as show the direction and strength of the trend. Right now, the S&P 500 is trading above its 50-day, 100-day, and 200-day moving averages, which are all rising. This indicates that the index is in a strong uptrend and has plenty of support below. The same is true for the Nasdaq and the Dow Jones, which are also above their rising moving averages. Moreover, the S&P 500 and the Nasdaq have recently broken above key resistance levels at 4,200 and 13,500 respectively, which opens the door for further upside potential. The Dow Jones is also close to breaking above its resistance level at 34, however, there are some signs of caution as well. The stock market is overbought in the short term, meaning that it has risen too fast and too far without a significant pullback. This can lead to profit-taking and consolidation before the next leg up. The Relative Strength Index, RSI, which measures the speed and magnitude of price movements, is above 70 for all three indices, indicating overbought conditions. The RSI can also diverge from price action, meaning that it makes lower highs while price makes higher highs. This signals a loss of momentum and a possible reversal. Another technical indicator to watch is the Volatility Index, VIX, which measures the expected volatility of the S&P 500 over the next 30 days based on options prices. The VIX is often referred to as the fear gauge, as it tends to rise when investors are nervous and sell when they are confident. The VIX is currently trading below 20, which is a historically low level that suggests complacency and lack of fear in the market. However, low volatility can also precede high volatility, as periods of calm can be followed by sudden spikes in uncertainty and risk aversion. Therefore, based on technical analysis, I expect the stock market to continue its uptrend in August and beyond, but with some volatility and corrections along the way. I think that any pullback will be an opportunity to buy the dip, as long as the major moving averages hold as support. Next, let's look at the valuation metrics. Valuation metrics are used to compare the price of a security or an index to its earnings, sales, cash flow, or other fundamental factors. Valuation metrics can help us determine whether a security or an index is cheap or expensive relative to its peers or its own history. One of the most widely used valuation metrics is the price-to-earnings ratio, P/E, which divides the price of a security or an index by its earnings per share, EPS. The P/E ratio tells us how much investors are willing to pay for each dollar of earnings. A high P/E ratio implies high expectations for future growth, while a low P/E ratio implies low expectations or undervaluation. Right now, the S&P 500 has a trailing P/E ratio of 29.5 and a forward P/E ratio of 21.8 based on estimated earnings for the next 12 months. These are both above the historical average of around 15 to 16 for both ratios. The Nasdaq has a trailing P/E ratio of 38.9 and a forward P/E ratio of 27.6 based on estimated earnings for the next 12 months. These are also above the historical average of around 20 to 25 for both ratios. The Dow Jones has a trailing P/E ratio of 25.9 and a forward P/E ratio of 18 based on estimated earnings for the next 12 months. These are slightly above the historical average of around 15 to 20 for both ratios. However, there are some reasons why these high P/E ratios may not be as alarming as they seem. First, interest rates are very low right now, which makes stocks more attractive relative to bonds and other fixed-income assets. Low interest rates also reduce the cost of borrowing and increase the present value of future cash flows for companies. Second, earnings growth has been very strong in recent quarters, thanks to the economic recovery from the pandemic-induced recession. Analysts expect earnings growth to continue at a robust pace for the rest of this year and next year. Therefore, based on valuation metrics, I think that the stock market is not cheap but not extremely expensive either. I think that investors are willing to pay a premium for stocks given their growth prospects and low interest rates. Finally, let's look at the sentiment indicators. Sentiment indicators are used to measure the mood and emotions of investors and traders in relation to the market. Sentiment indicators can help us identify extremes of optimism or pessimism that can signal turning points or reversals in the market. One of the most popular sentiment indicators is the put-call ratio, PCR, which divides the number of put options traded by the number of call options traded. Put options give the buyer the right to sell a security at a specified price within a specified time period, while call options give the buyer the right to buy a security at a specified price within a specified time period. Put options are typically used to hedge against downside risk or bet on lower prices, while call options are typically used to leverage upside potential or bet on higher prices. The PCR tells us how bearish or bullish investors are on the market. A high PCR implies more put buying than call buying, which indicates bearishness or fear. A low PCR implies more call buying than put buying, which indicates bullishness or greed. Right now, the PCR for the S&P 500 is around 0.6, which is below the historical average of around 0. The PCR for the Nasdaq is around 0.7. which is also below the historical average of around 0. The PCR for the Dow Jones is around 0.5, which is well below the historical average of around 0. These low PCRs suggest that investors are very bullish on the market and are buying more calls than puts. However, there are some caveats to consider when interpreting the PCR. First, the PCR can be influenced by other factors besides sentiment, such as hedging strategies, arbitrage opportunities, and liquidity conditions. Second, the PCR can be contrarian in nature, meaning that it can indicate the opposite of what it seems. For example, a low PCR can signal complacency and overconfidence among investors, which can make the market vulnerable to negative surprises or shocks. Conversely, a high PCR can signal panic and capitulation among investors, which can make the market ripe for a rebound or rally. Therefore, based on sentiment indicators, I think that the market is very optimistic right now, but this optimism may be excessive and unsustainable. I think that investors should be cautious and prepared for some volatility and corrections in the coming months. To sum up, my outlook for the market in August and beyond is cautiously bullish. I think that the market will continue its uptrend in the long term, but with some volatility and corrections in the short term. I think that any pullback will be an opportunity to buy the dip, as long as the major moving averages hold as support. I think that investors should focus on quality stocks with strong fundamentals, growth potential, and competitive advantages in their respective sectors.